$6.73 billion of permanent life insurance lapses weekly. In the mid-1980s, when prevailing interest rates were as high as 14 to 15%, there were only two types of life insurance contracts: term life insurance and whole life insurance. Whole life contracts contained an accumulation account known as cash value, which was typically earning 3% annually. The cash value was available to be withdrawn and used for any purpose, so long as the owner paid a contractual 5% interest charge on the money that was withdrawn. In a whole life contract, if a person had an accumulated cash value of $50,000 earning 3% interest, the owner had the ability to borrow the money at 5% and then place those dollars in a money market or savings account where they could have earned 14%. Thus, without any additional risk, the owner would be able to earn an additional 9% on their $50,000 of cash value. Due to the competition from banks' significantly higher interest rates, the insurance industry watched billions of dollars in their cash value coffers being withdrawn and transferred to the individual bank accounts of the people it insured. In order to stop these outflows, the life insurance industry created a new product called Universal Life Insurance, which paid an interest rate based on prevailing market interest rates instead of a fixed rate, as had been the case in whole life contracts. If interest rates rose, then one's insurance coverage would become less expensive or last for a longer period of time as a result of the larger amount of accumulated cash value. The problem faced by many insured today materialized because of the steeply declining interest rates following the higher interest rates of the mid-1980s. This resulted in 30 to 35% of today's universal life coverage on pace to expire years earlier than originally projected. While this interest-sensitive product stopped the tremendous outflow of monies from the insurance industry's cash value coffers to the banks, the solution was not a long-term fix because it created other problems that have just began to surface over the last 5 to 6 years as a result of today's record low interest rates. As a result, the original assumption that a life insurance contract would last until the person was age 92 has been shortened by as many as 8 to 9 years. While Universal Life has received most of the blame in the insurance industry, it needs to be pointed out that AA and AAA rated insurers are now beginning to also feel the effects of low interest rates as their whole life contract holders are being asked to either reduce their death benefits or increase their premiums as a result of poorly performing dividends which are not guaranteed. The combination of a low interest rate environment and the fact that the octogenarian demographic is the fastest growing segment of the population is a ticking time bomb for the life insurance industry. Another set of false expectations were set in the 1990s, using non-guaranteed variable life products during a rising stock market and creating the same disastrous effects. Fortunately, the industry has created a new generation of guaranteed mortality contracts. But the negative effects from 20 years of setting unrealistic expectations is just beginning to take its toll.